Welcome, everyone. My name is Nikki Johnston, and I'm with Transition Advisors. Our webinar today is Succession Planning, Alternative Deal Structures. Before we begin, we need to cover just a few important items. First, please close any other programs that you have running on your computer. This will just help to ensure a quality presentation and reduce any audio issues that might come up. Transition Advisors, LLC is a proud and approved sponsor on the National Registry of CPA Sponsors per NASBA. Under the new NASBA guidelines, today's webinar will qualify for 1.2 CPE credits. In order for you to receive those credits, you must complete two requirements. The first is that you participate in the polling questions throughout the presentation. There are 4 polling questions, and you do need to answer all 4 of them in order to get the 1.2 CPE credits. Please note that GoToWebinar does monitor your participation in these polls. Next, you'll also need to complete an online evaluation. This will appear on your screen immediately as the webinar ends today, so please do not close your browser until you've had a chance to do that survey. Once you've met both of these requirements, your CPE certificate will be sent to you by email within 10 business days. Now, in order to fully participate in the webinar, please take just a moment to familiarize yourself with the GoToWebinar control panel. You should see it on the right-hand side of your screen. The orange arrow is near the top, and you can use that to minimize the control panel. During the presentation, all the participants are muted, but you can communicate with us by using the question box toward the bottom of the panel. Just type your question and click send. Joel will answer all of today's questions as they come up or at the end of the session, time permitting. Now, finally, I'd like to remind you that Transition Advisors offers 2 free 1-hour CPE webinars each month. These are some of our upcoming topics. We have preparing your firm to grow through M&A, admitting new partners, and a 2 CPE session on succession planning and valuing your firm at the end of October. You can register for a list of all of the other upcoming webinars in the CPE courses section of transitionadvisors.com. Now, before I turn it over to Joel, we'll go ahead and launch the first of today's polling questions. This one is, how many equity partners do you have in your firm? So we'll give everyone just a few seconds to answer this. You see the options there on the screen. Got nearly everyone. Just a couple more seconds. Cast your vote, please, if you haven't yet. And I'll go ahead and close the poll. Joel, for your reference, we have 47% of the folks on the call are sole proprietors. Another 47% are in that 2 to 4 range, and then the remaining 7% are 5 to 9. Now, as I turn it over to Joel, first I'd like to remind everyone that I did send a link to the presentation that came in the reminder email you got from GoToWebinar, and I also sent it through the chat function just now. So if you'd like to download that PDF and follow along with the slides, you certainly can. If you'd like for the slides to be emailed to you, if you prefer that, you can just reply to one of those reminder emails. That'll come directly to me, and I'd be happy to send them to you. Now, all of that said, I'd like to introduce our presenter for today's session. Joel Sinkin is the President of Transition Advisors. Thank you all, and I hope you enjoy the webinar.
Thank you very much, Nikki, and hello, everybody, and welcome. Today, we're going to be discussing alternative deal structures, different ways to structure growth and succession plans. And if I'm interested in being the successor firm, if I'm looking to be the merger, or a seller, hopefully everybody's going to get value out of it because I'm going to be looking at everything through both people's perspectives. I never like to turn a CPE event into an infomercial, and we're not about to. But I do think it's important to understand the perspective of the speaker. For the last 26 years, the only thing I've done is help accounting firms in buy, sell, and merge growth and succession planning, partnership agreements, things of that nature. I've been involved in over 800 closings of accounting firms, and our company has some of the best-known consultants in the profession. Terry Putney, Bill Carlino, former editor-in-chief of accounting today. Mark Bazinski used to be in charge of international acquisitions at American Express. So we have a significant team. What we're going to be sharing with you today is because when you're involved in hundreds and hundreds of deals, you make mistakes. What you try and do is learn from every one of them. You're way better off listening to us in 2016 than 1990 because we try not to make the same mistake twice. As a result, we've gotten kind of smart about it. But the negative is, especially because our audience today is predominantly small firms. One thing that I could tell you is the smaller the firm, typically the more unique it is. If I took 5 firms doing $1 million in revenue, there may be the only thing in common is that they're doing the same revenue. How many partners, how much staff, rates, cultures. So in talking about deal structures and things of that nature today, if there's 50 things you got to know about any transaction, the smartest person in the room is going to think of 35. And we're not going to get you to 50 today, but we're hopefully going to get you further down the road and hope that common sense and good communication will prevail for the open issues that remain. Mergers and acquisitions, an extremely hot topic. It's been a hot topic for years. I write for the Journal of Accountancy and frequently contribute to Accounting Today. And there isn't a month that these magazines come out that we're not talking about M&A. But the reasons we're talking about them have changed dramatically. For example, in 2006 to 2008, we had tremendous organic growth. So the M&A activity was a lot less. And where it was people saying, I need talent. They weren't worrying about retiring partners. They didn't need billings. They needed talent to get the work done. Then we had the crash that came in 2009 and really all the way to 2012 where organic growth was very limited and mergers and acquisitions became very attractive again because it was the only quick way to grow. But today we're facing different issues. We still have firms that are very anxious to grow, but we still also have a staffing issue that we're trying to, so some people are looking in the merger and acquisition field to increase revenue. Some are looking to increase talent. Most who are buyers are looking to do both. There's also a big push to get niche development and have the opportunity to cross-sell additional services. So, for example, maybe your firm does a lot of law firms and as accounting clients, but I do a lot of business litigation support and valuations, and we merge together for cross-selling. Not listed on our sheet today, but very true for larger firms, is market development. Most of the top 100 deals you've seen in the last few years are them entering into a market by merging with a firm that's in an area that they weren't. But beyond a doubt, the most strongest variable that's been impacting the M&A activity is the aging of the baby boomers. Here we are in quite a conundrum. We have the largest quantity of partners ever looking over the next 2 to 7 years to slow down. At the time, we have the smallest talent pool to replace them. And the demographics are overwhelming. And just in 1993, just a pinch over 40% of the AICPA members were over 40 years old. In 2012, that number rose to over 70%. In 2016, it will be over 75%. The new survey is about to come out. In 2012, over two-thirds of the firms stated that at least one partner wanted to slow down. More firms said that they had more than one partner looking to slow down, again, way up from what it was in the past. Yet at the same time, only 25% of the practices said, a couple of years ago, said they even had a succession plan. A third in 2008, and less, only 30% in 2012. Jim Metzler, who's retired now but was the vice president of the AICPA Small Interest, was always panicking about how everybody was putting off their succession. So succession is a very big driving factor. It's not the only factor, but it's a big driving factor in mergers today. At the end of the day, mergers are always attractive because an accounting firm has very limited opportunities for growth. You have 3 measures. One is client at a time. In a good economy, growing one client at a time can be very attractive. In a challenging economy, it's treading water, just making up for our attrition. The other way to grow is developing marketable niches. We all see it now with wealth management and lit support and international tax and family office, where what we're trying to do is penetrate the same client base, with additional services. But by far and away, the fastest way to grow is still to merge or acquire another firm. I think one of the issues that a lot of us, I work very closely with the AICPA, and we talk about this all the time, is if I am thinking about slowing down, when should I start the process of planning my transition? And a lot of people are confused about this and don't understand the time frame that it takes to do a proper transition. When I'm posed that question, the first thing I ask a practitioner is, how many more tax seasons do you want to work full time? You know, many people ask how many more years you want to work before you retire. That's the wrong question. Retirement equals death. A lot of people don't retire, and most people don't ever go from working full time to 100% retirement. Most people find a lot of places in between. Maybe for the next year I'm going to work 80%, and then the following year 60%, and then 60% again. So the first question I ask is not when do you want to retire, but when do you want to start to work less? How many more tax seasons do you want to work full time? Now, let me tell you why that's a loaded question. It ties into face time, how much face time we have with our clients. You see, in 1990, when I first started doing M&A of accounting firms, most of the small firms I dealt with, the owners went out every month or quarter to visit their business clients. Heck, a lot of them did the work at the clients, wrote their check, the client signed it, and they left. We were in our clients' faces all of the time. Well, welcome to 2016. We now communicate with our clients in more ways and more often than we ever have before, but most of that is electronic and phone. So if you're not on the cloud, you're probably going to be. So we're communicating with clients directly through the cloud, through email, through phone, through fax. But according to statistics, 87% of our business clients were only in the same room with them, physically in the same room with them, once a year. Staff may be there more often, but the owner or partner once a year. So when someone says to us, I'm 3 years from slowing down, it sounds like an eternity. I say that's not 3 years, that's 3 visits. And the 13th Amendment prevents slavery. You can't buy and sell people. So you need to have a proper transition plan. Now, if you're one of those firms that still sees their clients 3, 4, 5, 6 times a year, it will take you less time to transition the relationship. But if you're like most firms where you have limited face time, you need to start taking advantage of that in advance. I look at 3 to 5 visits as the minimum I need to do a proper transition, because you can't really properly transition people through the cloud or the phone or email. It requires face-to-face. Now, there are other mitigating factors of when someone should start to plan their transition. For example, leases. I had a call from someone the other day down in Texas. They're a $1 million firm, 2 partners, and they were telling me about how one of them wants to slow down in 1 year, one in 5 years, and they're looking for a succession. Then they went on to say that they just signed an extension on their lease, and what a great space they have, and well appointed, and great location. And I said to them, I said, Mike, John, how big do you think your successor firm needs to be? He goes, well, we're doing $1 million, we're figuring 5 to 15 million. I said, don't you think they have an office? Here these people are facing to have to make, what period of time, the most important decision and last decision that relates to their practice. And by extending their lease, they've now eliminated 80% of the people that would have been interested. If I'm already in their town, I don't want to have 2 offices in the same zip code. So sometimes before you invest in leases and technology and things like that, if you know you're going to be getting out shortly, it makes more sense to merge with your successor and let them upgrade the technology, let them take on the space. But when should you start your process? The more loyal the clients are to you personally, the easier it's going to be to retain them, as we'll talk at the end. But the sooner you need to start, because you don't usually have as many visits as you used to have. The other thing that's changed a lot is one of the most popular questions I get asked when I'm teaching is it a buyer or seller's marketplace? And that has changed. You know, in certain areas, it hasn't changed at all. Since 1990, if you're a small firm in a densely populated part of the country, it's probably a seller's marketplace. Now, the bad news is, in 1990, you probably got 1.5 to 2 times. In the 2000s, you probably got 1.25 to 1.5. You're going to get less now. The values of practices have come down. You have a lot of things going against you. You have the supply going up of more and more baby boomers looking for a succession solution, and more firms that are challenged to have the talent to execute a succession plan internally, or the excess capacity to replace people. So there's less buyers than there used to be because of the talent squash. and there's more sellers. So supply and demand has come up. But it's still a seller's marketplace if you're, for example, in Nassau County, Long Island, a part of New York, one county that has over 3,000 CPA firms. But if you're 2 hours outside of Boise, Idaho, you might be in some of the most beautiful country that we have, but there might be one accountant for every 3 zip codes. In those cases, it's a buyer's marketplace. I've had people tell me I would never buy my competitor's practice because if they retired, I'm the only other one in town they'd go to. So if you're a small firm in a densely populated part of the country, it's still a seller's market. If you're in a very sparse area of accountant firms, it's more of a buyer's market. The other place where it's been impacted is the size of the firm. The larger the firm, the smaller the market. Remember, there's 45,000 CPA firms that are members of the AICPA. 33,000 are sole practitioners. Now you have the top 100, which brings you to about 37 million. Then the G400, which brings you to about 8, 9, 10 million. Then you have the other 44,500. So if I'm a $10 million firm in Oklahoma, there might only be 2 firms in the entire state that are local firms, not national firms, that are big enough to take me over. So both the practices have come down, especially for larger firms. It's been more noticeable for larger firms. And the demand has come down. So larger the firm, the smaller the population exists that's large enough to take you over. Less dense population, more of a buyer's market. Smaller firm, dense population, more of a seller's marketplace. But now we've identified 2 firms that want to affiliate. How do we structure the deal? Where do we go from there? Well, before we worry about deal structure, we should make sure we're choosing the right successor. You know, one of the things you'll hear me speak about frequently is bigger is not always better, better is better. But I had someone who questioned me about that. They said, what do you mean? When I said to them to be more specific, which I should have been this whole time, is if I'm a sole practitioner, one of the main jobs I do is hand-holding. My clients could fill out the tax and outline and send it in, but they're not going to. Half of them want to come in and tell me about their kids and their college education fund and their grandparents and whatever they want to talk about. But there's a hand-holding aspect. We're part of the family. It's very hard to take a firm where the partner takes a personal interest in the clients and merge it into a large firm who's going to send out a junior to deal with a client that's used to dealing with the principal, whose fee structures don't make sense to each other. Bigger isn't always better. It is a lot, but how much bigger? So what do you need to focus on? First thing I do if I'm looking to merge up is I want to know why the other firm wants to merge me in. Sometimes you hear a great answer. Well, I got a lot of young talent. I want to promote them to being a partner. And if I figure if I bring you in and when you slow down, I could promote them to become a partner without giving up more of my equity and control. Good answer. Bad answer. Well, I've got a lot of extra space. I figured if I bring you in, I would reduce my overhead. If the only purpose of doing a merger is overhead reduction, sublet the space. A merger is a marriage. We spend more waking time with our partners than our spouse. It's a horrible reason. So why does the other firm want to merge? Do they have staff? Do they have capacity on what levels? Partner levels, staff levels. It's going to tell us a lot. If I'm a 3-partner firm and 2 of us want to slow down in the next 3 years, and the firm we're talking to has no excess capacity on a partner level, how are they going to replace me? Do they have the physical space to move us in? Does their technology make sense to ours? One of the other things that's always interesting to me is I've been involved in, as I mentioned, over 800 closings of accounting firms over these 26 years. And I've never had a successor firm not perform due diligence on the firm they merge in, and how rare it is the smaller firm does any due diligence on a larger firm. At least make sure they have the financial strength, and they don't have any litigation issues. At least make sure that run a credit report. If they're robbing from Peter to pay Paul, you don't want to wake up one day being Peter. Bigger isn't always better. It can be. Let's make sure that they have what it takes to make sense to you. Do they have the specialties you have? You know, some people think everything's a specialty. Not everything is, but I had a practice doing broker-dealer work, and I had someone ask me what that was. I said, well, then the firm's not for you. If you don't know what 17A work is, the seller, they weren't looking to teach you. They were looking for someone to help them. So if I'm choosing a successor, I want to make sure they have the licenses, if required, that they need to do my work. I want to know, what their retention rate's been. How have they been doing with keeping their clients and their staff? Because if they can't keep their own clients, why would I think they're going to keep mine? Do they have the capacity? Do our billing rates match up, or are they going to have to dramatically raise the fees? Location can be important and can be irrelevant. It's irrelevant, for example, other than where the staff and owners live, if all the work is mailed in or done through the cloud or we visit the clients. The location could be pretty important if all the clients physically come to the office to drop off the work. But the big thing when selecting a successor isn't how deep their pockets or great their technical skills. It's, do they have a culture that makes sense? Let's remember that almost none of you on the phone have more than 1 or 2 clients who really know if you're a competent or incompetent accountant. Because if they knew that much to measure your technical skills, why are they paying you to do the work they completely understand? They're hiring you because they don't know what they're doing. They're staying with you because they trust that you do. So are your clients brand loyal or partner loyal? All of you on the phone are in relatively small firms or sole practitioners. That's partner loyal. See, at PwC, if the partner retires, they slap another partner in. They're not leaving PwC probably because the bank told them they had to go to PwC. But a small firm are partner loyal clients. Does your successor have partner loyal clients? How do they manage them? And then there's certain cultures that are tough to intertwine. For example, I charge all retainers. You charge all time and billing. I do value billing. You do differently. All right? Maybe we're a one-firm client mentality. Your firm is an eat-what-you-kill firm. How are we going to match those things up? So does the cultures make sense? Very, very important. Do they have the financial strength, the professional strength, the capacity? Some practices, there's ethnicities and language involved. We're also politically correct. We forget the realities of a practice. 5 years ago, I had a small firm in Astoria, Queens. If you didn't speak Greek, you couldn't acquire it. It's just the way it worked. I worked with a practice last year in California. It had to be sold to women-owned firm. Why? It was women-owned. Their whole marketing policy has been women-owned accounting firm helping women-owned businesses. Well, you can't be selling that to all testosterone. You need some estrogen there. These are the realities of it. One of the things that isn't on everybody's radar that you want to put in is how long have the partners been together? If I'm merging into a firm and they are brand new, have never been partners before, it makes me a little nervous. If I'm using a staff person as my successor, I want to look at their track record. Have they retained the clients? Do they get the job done? Do they show up? Do they bring in new business? These are all some of the things that you have to think about when selecting a successor. Well, let's make sure you get your CPE. Let's do the next polling question, and then we'll do deal structures themselves.
Okay, the second polling question's on the screen. This one is, how many more tax seasons do you plan to work full-time? And your options here are 1 to 3, 4 to 6, more than 6, or until I die at my desk. I'll give everyone just a few more seconds. And again, this is the second of 4 polling questions. In order to get the 1.2 credits, you do need to answer all 4 of the polls. And I'll go ahead and close that poll. The results are there on the screen. We've got more than half say that they're going to work more than 6 years. About a quarter are in that 1 to 3 range. And then 13%, 4 to 6, and 4% until I die at my desk.
And you should all have the right to work as long or as little as you want. I'm not a fan of these mandatory retirements. I get them. They're an important tool to attract young talent. I think if you own your practice, you shouldn't have to retire based on your birth certificate or ever retire. For those that are 1 to 6 away, hopefully you're thinking about starting to get your succession plan done. For those more than 6, maybe you're looking to be the successor to some of these other firms. But this brings us to the deal structure. If I'm selling my practice or if I'm buying someone's practice, there are 5 main deal structures that you'll see out there. There's more than just 5, but these are the 5 main ones. The first one is probably the second most popular one that I'm involved in. It's a straight sale. Now, let's not confuse what I mean by a straight sale. I don't mean that I sold my practice and I went to Boca Raton tomorrow and I'm gone. What I mean by a straight sale is hopefully I'm still going to be there to help you perform a transition. Maybe I'm even interested in staying on to work part-time. but I'm no longer looking to work full-time, and I'm not looking to be an owner or have equity in it, a straight sale. Now, I always feel that someone who chose a straight sale probably was better off starting that process earlier and doing a two-stage deal, as we'll talk about a two-stage deal at length in a moment. But if you're doing a straight sale, just keep in mind, you need to stay of counsel, or you're going to put yourself in harm's way. If you're going to rush through a transition, and if you're not going to remain of counsel to the firm, it could have a negative impact on client retention. And if it has a negative impact on client retention, everybody loses. Because most of you, if you're going to sell a practice externally, not to a partner, but to someone else, you're going to get paid tied into client retention. So it's in your interest to make sure that you give yourself adequate time and create a transition plan, and we're going to talk today about keys to retaining clients, so that you maximize your years of sweat equity by getting a good return by retaining the clients. If I'm the successor firm, I'm not buying a practice to lose clients. My goal is 100% retention. My goal is growth. Maybe you were providing A, B, and C services, and we're a little bit bigger, and we have a bigger platform of services. I'm hoping to turn your $400,000 into $500,000, not by raising fees for the same service. That doesn't help you retain clients, but by bringing more things to the table. A buy-in to a buyout is one of the less often deals, but can be done. Let me give you an example of that. Let's say that Nikki's got an $800,000 practice and I have a $200,000 practice, and Nikki's looking at a near-term succession plan, 3, 4, 5, 6 years from now. Well, maybe what we do is we start by merging together. The new firm's $1 million. For me to be a 50% owner, I needed $500,000, but I only had $200,000. So initially, I acquire from Nikki $300,000 in revenue, the buy-in, typically with a payout period over years. And then when she retires 5 years later, I buy out the balance 50%. So that's a buy-in to a buyout. There are times where, as a buyer, I might do a buy-in to a buyout with a seller, but keep my practice on the side. Had a seller 2 years ago in Chicago who didn't want to have any of the liability and exposure of the buyer's own practice. So they said, look, you keep your practice separate. In a different entity, you could buy into my firm and buy me out, but I don't want to be part of the ups and downs of your practice. So there's different thoughts about it, but that's a buy-in to a buyout. A merger to a buyout is very similar, but there's no initial acquisition. So if we use the example I used before where Nikki had $800,000 and I have $200,000, the new firm's $1 million and I own 20% and Nikki owns 80%. And when she goes to retire, I have to buy the 80% equity from her. Many firms will do a merger to a buyout where, let's say I'm $1 million and you're $2 million, we merge together, I'm a third, and then when I go to retire, you're going to buy me out. A merger to a buyout. It's kind of interesting, and it's been happening more and more. It's still not as popular as a straight sale, or clearly not as popular as a two-stage deal, but a carve-out or a cull-out sale. There's a couple of different types of them. Let me give you a couple of examples. One example is a cull-out of a niche to retain or sell. For example, a couple of years ago in the D.C. area, I was working with a firm. They were a relatively small firm, $800,000-900,000 in accounting fees, but they also had several $100 million of assets under management. This owner of this practice loved the wealth management and the financial planning, was not a fan of the accounting, but always felt that his accounting practice was the springboard that got him the wealth management clients. And he happened to read an article I wrote for the Journal of Accountancy and reached out to me, and we did a different plan. What we ended up doing was we brought him to a firm that was doing $4 or $5 million, that had a lot of high net worth individuals, but wasn't doing wealth management. He culled out the traditional accounting and compliance and tax work of his practice, sold it to this larger firm. He signed a non-compete as it related to accounting and tax work. The firm signed a non-compete as it related to wealth management. We sent out an announcement letter that Jay said, hey, nobody can stay on top of the day-to-day changes in the stock market and all the constant re-regulations in tax and accounting. So I've merged with John and Jane Doe. They're going to help me by focusing on this side, and I'm going to focus on that side. A merger of specialties, it sounded like. The seller of the accounting practice literally moved in with his successor firm. The successor firm loved that because by being there, he was the glue that cemented the relationship on the accounting side. Plus, the $4 to $5 million firm had several clients that they felt needed a good wealth management person. They referred the wealth management of their clients to the person whose practice they acquired. Because that $4 to $5 million firm was licensed, they were able to get a referral fee. So we basically had the buyer acquire part of the practice, seller retained their niche, and created a new business incentive program where they both referred people to each other. Everybody won, a cull-out sale. They culled out and kept their niche and sold the traditional practice. You also occasionally see people sell the niche and keep the other practice. Another type of cull-out sale that you'll see occasionally and more lately are some people that want to keep their hand in play for a little while. A great example is in Florida this year, we had a gentleman with a small $600,000 firm. There was $125,000 of clients that he loved working with. Some were family, some he'd been working on for 20, 30 years. They weren't his best payers. As a matter of fact, most of them weren't even great payers. They were older clients that were paying less, but he loved them. He culled out this $125,000 worth of clients. He sold the buyer the $500,000, signed a non-compete other than the clients he retained. So he got paid for his $500,000 practice. He actually moved in with his buyer and ran his 125, where his gross practically became his net. You add his purchase price on the 500, he was making fairly similar money, working about 10, 15 hours a week. An unusual situation. But he didn't want to completely retire, but he wanted to reduce his time commitment. And by the way, he gave the buyer the first right of refusal to acquire the clients that he retained at a later date. Another type of cull-out sale, where it's a step towards retirement, but you're still keeping a little bit of game in play. Third type of cull-out sale that we've seen recently is a firm that had a succession/staffing issue. It was a firm in the West Coast. They were doing $3 million. They wouldn't merge up. They had 2 of their 4 partners looking to slow down. They had spent years trying to develop the talent to replace them, and they couldn't. They brought me in to do a retreat for them, and even though the real answer for them was an upstream merger, they just won't do it. They refused to consider the possibilities. They were worried about the accountability, normal things they were worried about, but to an extreme point. But these 2 partners said, I want to retire. How are we going to handle it? Well, we took $1 million of their lowest paying clients. This 25% of their client base took up 60% of their time. They sold it to somebody else for 20% of collections for 5 years. They made more money selling it than keeping it. But by selling it, they created the capacity they needed to manage the rest of the work, kind of cutting off the leg to save the body type of thing. So that's a very unusual thing. But these 3 different types of cull-out sales we're actually seeing. It's people keeping the niche or selling a niche, keeping themselves a little busy in their first stage of retirement. But by far and away, the most frequent deal that our firm's involved in is a 2-stage deal. A 2-stage deal is established for people that are 5 years or less, even 6 sometimes years or less from slowing down, but still want to maintain reasonable control, autonomy, and income. Let me tell you where this came from. I went around for many years for the AICPA and state societies and other accounting organizations teaching about succession planning and saying, hey, why do you have your clients? It's because of you, and your clients love you, and it takes time to transition them, and it can't be done overnight. And everybody agreed with me, and nobody did their deal. Now, a smart person would have figured out in a week or 2, a month or 2, at least a year or 2, why? Okay, 10 years later, I finally came to the conclusion that the reason people won't do it is control and accountability, especially your smaller firms. If you're master of your own domain, the idea of merging with someone and having that level of accountability and no longer being in 100% control was so intimidating. The idea of that change was so scary that you'd rather not do what you know you need to do and start your succession plan and keep putting it off. And I get that. So what we needed to do was come up with a plan that enabled someone to maintain control, autonomy, and income, but still have a succession plan, hence a two-stage deal. Let's walk you through it. Let's start with stage one and how you started. Let's say I own a practice. I'm doing $500,000, including perks, benefits, phone. Let's say I net 40%, just to pick a number out of the sky. That's our premise, and I want to work 3 more years before I slow down. Now, the first thing the successor firm and I are going to do is calculate how much labor I use in order for me to get the job done. So let's say I use a full-time CPA, a full-time paraprofessional, and a per diem during tax season. So now we've established, here's my client list. I'm personally making 40% on them using this much labor. Now, if I was a 10-partner firm, instead of worrying about how much labor a partner used, it would be more focused on how many hours I put in. But we're going to focus, because most of you are smaller firms, on the opposite. So instead of, I'm not worried if you put in 2,000 hours, 3,000 hours, how much chargeable. I want to know more about how much labor you use, and I'll explain why in a minute. And then how long I want to work before I slow down. So we've established it. 40%. I have, let's say, 3,000 hours of professional time and 2,000 hours of clerical time, plus what I do to make my 40%. The buyer says to me, Joel, you come on in with me. Hey, you come and go as you see fit. But I'm going to take over all of the operating expenses, the rent, the labor, the software, everything. But I'm going to keep you whole in income. If you're making 40% of what comes in, I'm going to hire your entity as a consultant and pay you 40% of what comes in. And I'm going to pay it to your entity, because this way you'll still have all the tax advantages you had in the past, feeding retirement plans, paying your kid's cell phone, paying your medical insurance, your lease. You don't have to worry about me approving it, just like you were doing before. And the reason I don't really care how you come and go is because that's not what costs me money. What costs me money is how much staff you use. So I'm going to be responsible to give you those 3,000 hours of CPA time and 2,000 hours of clerical time. If you need more than that, that's a problem. If you don't need more than that, what do I care how much you come and go? So you're not a clock punching employee. I'm going to cover the expenses. I'm going to pay you 40% of what comes in, and you get the tax advantage of it going through your entity. I get the tax advantage of having it as a current deduction. And I'm not worried about your time commitment. In stage one, there's really only 2 ways I'll make less money as the seller. The first way is if my fees go down and I lose a client. But think about it. If I stayed on my own and I lost a $20,000 a year client, I'd lose $20,000 of income. All my other expenses are fixed. Now I only lose 40%. So it actually mitigates my attrition factor quite a bit. The other way I could make less money is only if I suddenly needed more labor than I used in the past. The only reason I'd need more labor is if I decided to work less. And if I don't do a deal with you and I want to work less, I got to hire labor to replace me. Well, in a 2-stage deal, during stage 1, if I want to work less and you have to make up the difference, I've got to give you compensation for doing that. So during stage 1, the seller's kept whole, provided they don't need more labor. The buyer assumes all the operating expenses, and it's held out to the world as a merger. The buyer's billing it under their name, but they're still dealing with the seller. They meet the people. We're making a transition. When I bring the seller in, since that seller was probably doing all the billing, the collections, the IT, a lot of the administration, we're probably going to take most of that over. That's going to give the seller the opportunity to spend some time doing the transition, spend some time doing some introductions, spend some time growing the practice, and maybe just spending less time on the practice and enjoying life a little bit more. But because we had this 3-year stage 1 together, it's much more likely we're going to have a very strong retention rate. Our retention rates at the commencement of stage 2 has been over 95%, not including people who died, went out of business, or relocated. But we very rarely lose a client to another accounting firm. So stage 1 is kind of the merger period. During stage 1, it's clear why the seller will do it. They got free backup and support. They got a built-in practice continuation agreement because if I get hit by the bus, it automatically accelerates to stage 2. So when everything's clear on the buyer, why the seller does it, why would the buyer do it? Well, first of all, in my little practice, I was probably paying 40, 50 grand a year rent. When I move in with you, you're going to get to keep that money. Maybe you don't need my clerical or my per diem. You're still going to give me the same support, but you're probably going to save something on labor, rent, software. The synergies of the deal during stage 1 go to the successor firm. Now, I'll tell you, just a couple of weeks ago in Kansas, we were working on a deal, and the seller called me up 2 weeks before closing and said, you know what, they're saving $100,000 in overhead. I should get some of that. And I yelled at him, and I said, what? No, you shouldn't, Mike. You got everything you wanted, autonomy, control, income, come and go as you see fit, succession plan, everything you wanted. You didn't come to me to make more money. Part of the reason the successor firm's doing this is because they want to get a benefit. They're taking on all the liability and exposure, all the administration. They're spending time to meet the clients. There has to be something in it with them. Thankfully, it doesn't come from you. Everybody wins. The buyer gets some synergies. Seller gets independence, control, income. And then we go to stage 2. Stage 2 is the buyout. You see, I can't keep you whole in income and pay you for your equity at the same time. If you try and get paid purchase price and salary at the same time, you're going to get less than your practice is worth and less than your time is worth. Why would you do that? So by deferring the purchase price to stage 2, you can maximize both. Stage 1 ends and stage 2 begins typically at the end of a back date or, God forbid, a health reason, or the seller simply says, hey, you know what, I've decided to work less sooner. If I'm buying your practice with a retention period, which most deals have, keep in mind the retention period doesn't start till stage 2 because during stage 1 the seller's still running it. But most of the time my sellers stay on during stage 2 in a part-time role. We usually pay them compensation. Most frequently we pay them a third of what they're billed out for. They don't come back in to do a bank rec. When they come back in, they're doing high-level work. They're getting a third of it, which is a good number. As a successor firm, I'm tripling labor, and I'm only paying for chargeable time. Again, it works for everybody. We also give the seller a new business incentive program. Sometimes we'll even say any new business you pick up during stage 1 can work to replace any lost clients, if any, during stage 1. But we'll usually give a seller a new business incentive program that enables them that if they bring in new business, they get a reward. And we're going to give them a good value on their practice. And because we had such a great transition, we're going to retain the clients. If we retain the clients, everybody makes more money. Because remember, the multiple, which everybody wants to talk about, what's the multiple? And you attend our class on how to value a practice. I'm doing a lengthy one in October about it. What you'll find is the multiple is the effect. What we really worry about is the cause, how much money up front, how long is the payout period, how long is the retention period, how profitably the deal is. But that's another CPE class that please come in October. We'll give you unbelievable detail about that. What's really great about understanding all these different deal structures, though, is the following. When you're not a sole practitioner and you're a 2, 3, 4, 5 partner firm, as many of you on the phone are, it's pretty rare that all partners are in the exact same place at the exact same time. For example, last night I had a dinner meeting with a firm in the New York area that has 5 partners. One wants to slow down in very, very near future. One wants to slow down in 3 to 5 years. The other 3 are in their 40s and early 50s. They want to work 10, 15, 20 more years. So how do we go to a successor firm and work out something? And they need a successor firm because the 3 of them that want to stay on don't have the capacity to replace the 2 that want to slow down. So here's what we do. We talked last night about the one gentleman who wants to get out the soonest. We're going to do an immediate sale for him. One of the deal structures. The gentleman that wants to work 3 to 5 years, we're going to do a 2-stage deal for him. And the 3 that want to stay on are going to do a merger where they're going to exchange equity in their firm for equity in the successor firm. So what we're enabling ourselves to do when you understand these alternative deal structures is have a firm that has partners in different places do one deal with one firm, but each of them get a unique aspect of it. So as the successor firm to that 5-partner firm will be, I'm going to sit there and say to the 3 of them, come on in, be part of our firm and grow with us. The one who wants to work 3 to 5 more years, hey, we want to give you autonomy, control, income, We'll keep you whole in income, and at the end of the third, fourth, or fifth year, when you slow down, we'll start your buyout. And the other gentleman wants to get out right away, we'll start your buyout right away, and we'll give you another council role in a new business incentive program. So it's a wonderful thing to get your arms around these alternative deal structures so you can feel better about not having each partner forced into doing something because somebody else wants to. You kind of customize it to that way. A couple other things that you need to think about when you're doing your deal structure, just as an FYI. Small firms will often ask me, what about my furniture, fixtures, and equipment? My answer is, it's a throw-in, it's worthless, never ask me again. The computer you bought 2 years ago is worthless. Now, it's kind of funny. When you take on a $10, $20, $30 million firm, we do pay that book value for the hard assets. But to replace, when you're bringing in a $20 million firm, that's a lot of technology to replace. When I'm bringing in a 1 or 2 partner firm, it's a very rare time there's additional value placed for hard assets of furniture, fixtures, and equipment. Right? Avoid leases. Try not to commit yourself to a lease, a long-term lease, if you're looking to do a merger. You're going to eliminate a lot of people. You know, so make sure that you keep in mind of that. One of the other things that come up a lot is, in a two-stage deal or any type of sale, what happens after we close the deal if for the same services the buyer is able to raise the fees? How does that impact the purchase price? Well, most deals that are done that have a retention period, it's very unfair to say to a seller, this client went out of business, you're no longer going to get paid for it if it's during the retention period. Oh, and this client doubled his fees, but you're not going to get that either. If it's a good deal is a fair deal. If the seller's going to participate on the downside, they surely should participate on the upside. There are times, though, that if it's an increase in fee from a new service never done before, maybe they'll participate on it a little lower of a level. For example, I had a firm in Pennsylvania Virginia, that referred out all their audits. The Successor firm did audits, but audits weren't as profitable as some of the other work. So they agreed that the Successor firm, instead of farming it out, would keep the audits, but instead of paying the proverbial 20% of collections for 5 years on the audits, they're paying 10% for 5 years. It still found money to the seller. In other deals, I've seen it pay the same value. What's very rare to ever see is a seller participate in fee increases from referrals from the clients acquired. If, as the seller, I refer you a client, I'll usually get a piece of it under the new business incentive programs. And by the way, be generous with them. I was speaking to a firm last week in Georgia that wanted to offer this firm 5% of collections for the first year on any new business they developed, and referred to the firm. My question to that firm in Georgia was, would you be motivated by that? Would you be out there aggressively looking to bring in new business for 5% of the first year? Offer 15%, offer 20% for 2 years, 15% for 3 years. If you were to charge a client 10 grand, charge a little more. If you get them, great. If you don't, you never had them. It's ice in the winter, but if you're going to make someone an offer, make it work. Make it of value. But it's very rare if I acquire your client base and someone in the client base refers a client that the seller will get that. That's part of the fruit of my labor. So those are some other things to keep in mind. Let's do our third to last polling question so you all get your CPE, and we'll talk about client retention and due diligence before we finish.
Okay. The question is there on the screen. This one is about, what does your firm's most likely succession plan look like? Selling internally, finding an external buyer, or you're not sure? As Joel mentioned, this is the third polling question. We'll do one more at the very end. And I'll leave it open for just 5 more seconds. If you haven't voted, please go ahead and do so now. Okay, I've closed the poll. The results are there on the screen. 44% will find an external buyer, 36% plan to sell internally, and then the remaining 20% aren't sure.
Very normal, very explainable, but let me just give everybody one heads up. I just want to make sure this is nobody's succession plan. Joel, I'm going to find a young person that I'm going to train and groom to be my successor, because that's a pipe dream. That's not a succession plan. The greatest commodity in accounting today is young talent, especially young talent with a book of business. And the $10 million firms and $100 million firms have the same succession issues everybody else does. They're giving these people signing bonuses to come aboard. That's how tough it is. So if you're thinking that your succession plan involves recruiting more talent, be realistic about the end result of that. If you have the talent on the bench, great. If you're looking for a firm outside of you, make sure they have the right culture, the right chemistry, the right capacity, all good. Just want to warn everybody, if you're looking for that needle in the haystack, that's a pipe dream, not a plan. We discussed before the importance of performing some level of due diligence. Let's talk for a minute about if I'm merging up because I'm selling, I'm a mergee, what should I focus on? Well, I gave you a list. I'm only going to talk about parts of the list. I think it's really important to understand the background and everything of the firm for sure. But I really want to know other things about them. The important things to me that I look at is their own client retention rates. If I'm merging into a larger firm, I want to know how they're doing with their client retention, with their staff retention. Are they a turnstile? Or do they have clients that nest? They come in there and they nest and they don't leave. That's what I got to focus on. I want to look at their compensation package for their staff and their employee manual for their staff. Are my staff underpaid, more than paid? Are their benefits the same? How's that going to impact the client with the staff retention, which will impact the ultimate deal? One of the other things not on this list that you really want to focus on is if they've ever done a deal before. Part of your due diligence is speak to the firms they've merged in. If they've done the deal before, there's a track record there. And I'm assuming you're going to hear good things, so it's not just to hear good things. It's also to ask the questions. What was harder than you thought? What was easier? They've gone through the process that you're looking to go through with the same firm you're considering going through it. There's some that could be learned. Make sure of that. Make sure they have the capacity, the culture, all the things that it takes to be your successor. If I'm merging into if I'm the successor firm, again, there's some things to look at that are a little bit different. Who does the work? Where's the work done? Right? In California, we ran into a practice that's old school. The owner of the practice goes out every quarter to see every client. Well, that's important to know because if you're not going to be able to spoil that client in the same way, are you going to be able to keep them? Right? Where's the work being completed? Most of the time it's being done in the office, but if it's being done in the client's location, that's a problem. You got to know it. What clients require FaceTime? How do the fees match up? Be careful of what I call the great mystery of billing rates. Some billing rates and profit really aren't what people think it is necessarily. And I know that sounds strange to speak to a group of CPAs about. But let me give you an example. Let's start with a story of a deal we did in Atlanta. It was a firm doing $1 million that had two CPAs that were owners. They both wanted to slow down at the same time frame. What was interesting about their firm was they had 4 staff. All were basically glorified bookkeepers and paraprofessionals. The only 2 CPAs were the 2 owners. They did all the heavy lifting. The client that I was consulting with went in to do due diligence and called me up and said, look, there's a problem. Joe and John are great guys. We love the firm, but they're only getting $200 an hour for partner time. That's a real problem. And I said to them, well, you just did the due diligence, not who's going to be the client contact person and hand holder, but in your firm, who would do the work these 2 partners are doing? Because the firm I was speaking to, the Successor firm, has partners, managers, seniors, juniors. They said 90% of the work these partners are doing is senior level work in our firm. I said, what's your senior billing rate? They said $125 to $150. I said, I guess they're getting $200 now. See, they were focused on the partner billing rate, but it wasn't going to be a partner who did that work in the Successor firm. Apples and pears. So what you need to do as a Successor firm in due diligence isn't just look at what they're doing, but transfer what they're doing to what you'd be doing. It could be a positive, it could be a negative. Maybe your quality control process is more robust and it will take you more time and effort. I've lost deals over that. Maybe your technology is way more efficient than them and will take you half the time and effort to derive the fees, and you'll be able to leverage that work down to staff, in which case profit's huge. See, even things like profitability, people make a mistake on. Let me give you an example of what I mean by profitability being a mistake. Let's say I have a $300,000 practice, and 5 years ago I ran it out of my home, and my wife, Kathy, answered the phone. What was my net? 85%. Then we decided we didn't want people knocking on our door, so I took an office. She didn't come with me. I hired an office manager. Now I'm netting 45%. At which point in time was my practice worth more to you? When I was netting 85 or 45? It's irrelevant. If you could absorb my practice with no incremental increases, it's profitable. If I ask you to keep my location, if I ask you for goodwill and you have to deduct it over 15 years and I want to be paid over 5, it's less profitable. So it's not the profit of the seller, it's the profit of the deal for the successor firm. That's got to be part of your due diligence. It's not just P&Ls and work papers. It's other types of things that you need to focus on. All right? To me, the key of choosing any partner to do a deal with, whether I'm the buyer, seller, mergee, merger, are the 4 C's. First one's my most important rule. It's the chemistry test. If you don't want to eat lunch with someone, don't do a deal with them. You have your clients because they're comfortable with you. Your staff's comfortable with you. If you're not comfortable with someone, why would your clients be? Continuity is the next thing. I'm going to ask you to make wholesale changes to the way that firm's operating. That's in front. That's bad news. Your clients chose to go to you. They like the way the ship is sailing. You want someone who's going to keep it, at least visually from the outside, looks like it's going the same. Does their culture make sense? I've had cultures defined 100 ways. Whichever way you define it's probably the right way. It could be dress code. I go out in a jacket and tie. You go out without one. It could be billing that we do. We bill out WIP every month. Others don't bill out retainers. What kind of cultures are there? And one of the C's that not enough people think about is capacity. Do they have the capacity to replace us? Remember, a good deal is a fair deal. The seller should be paid for their years of sweat equity, but the buyer has to make a profit or there's no reason to do the deal. And all these things are a package. But the key to any transition, the key to any merger acquisition working is client retention. Clients are retained. Everybody makes their money. Everybody's happy most of the time. So what are the keys to client retention? You start by understanding the 4 fears that clients have. The first one is the person I trust still there? The second fear is this going to cost me more money now that I heard about this merger? The third one, for clients that come to your office, is, so am I now going to have to drive someplace that's not convenient? And for some of your clients who are used to dealing with staff, are they going to be there? So you need to address these questions. You need to address them up front. So, for example, if I'm doing a transition plan, what I'll do is, let's say I'm selling my practice to Nikki. I'll probably break my client base into categories: doctors, retail, wholesale, service, whatever. So let's say I'm sending an announcement letter to the doctors. It would go out in my envelope with the new stationery inside, because if it goes out in the buyer's envelope and they see a new accounting firm name and address, they might throw it out and think it's a solicitation, a letter from their accountant they're going to open. When they open it up, there's Nikki's stationery inside with a letter for me. Hey, I'm pleased to announce I've just merged with Nikki Johnston. Nikki's an expert in the Obama tax laws and the modern computerization of accounting, especially as it relates to the medical community. So she'll be working with me on your account, and even though she'll be bringing all this additional expertise to the table, we'll be operating under the same fee structure. The same critical staff you're used to dealing with are part of our new combined dedicated team of professionals. We remain geographically sensibly located here in Kansas City, Kansas for you. And I remain the principal in charge of you as a client. So if a client gets a letter that I'm still there, the fee's the same, I have an expert in your industry that's working with me, the staff's here, the location's here, the greater the loyalty between me and the clients, the easier it is to retain them. But not everybody gets an announcement letter. You have to decide who gets a letter, who gets a visit, who gets a phone call. You don't send a letter to your biggest client, but you don't go alone. Remember, many years ago, a gentleman named Murray went out to see his biggest client and told him about this new guy, John, he merged with, and the client said, Murray, congratulations, but you're the only guy I deal with. If he brought John, they went to say, John, nice to meet you, never want to see you again. So there's very important when you're going about your transactions to choose the right deal structure, choose the right partner to affiliate with, put together a plan that everybody wins, and you'll be able to structure deals. Go to our website anytime, transitionadvisors.com. You'll see a resource section. In the resource section, you're going to see a huge amount of articles on due diligence, internal succession plan. Help yourself. They'll give you a tip. But let's get you that last polling question so you can get your CPE and run.
Okay, the final polling question is on the screen. And I'd also like to remind everyone that once we end here momentarily, don't close your browser just yet. The survey will pop up there in the screen and you'll complete that. That's the other requirement for receiving your CPE credit. Joel mentioned our website and the resources there. You'll receive an email from me later this afternoon that will include links to several articles that Joel feels are relevant to today's topic that you might find interesting, and then you can certainly spend more time while you're there on the website looking at some of the other articles that we have. Looks like that's nearly everyone, so I'll go ahead and close the poll. Thank you all for your time, and I'm going to go ahead and end the webinar so that you can all complete the survey, and then you'll receive your CPE certificate from me within 10 business days. Thanks so much.